welcome.
Good afternoon.
We kidded when you walked in. It's a shame there's nothing going on. Jenny just laid out a lot of different scenarios. How are you guys thinking about it in your group?
Look, I mean, the first thing that we're doing is taking a healthy dose of reality and recognize that we're managing a lot of noise right now. So we're jumping headline to headline. This person's having a conversation with this person and that person denies it. It's very, very noisy. So what we're trying to do is take a step back and look at trying to look at what some of the fundamentals are. The first place that we start is the initial conditions in the markets going into this war, which is that, the economy was relatively strong, a lot of fiscal stimulus, inflation was on the way down. The fiscal stimulus has put a lot of money in consumers' pockets just due to tax refunds. That means that the consumer can probably absorb some of the shock of higher energy prices for the near term. The question that you asked, Jenny, and the right question is, so how long does this last, right? What's the duration? What's the tipping point where this becomes something worse? We don't know what the answer to that is, but I do believe, though, that we are in a period here of negotiated escalation where there's going to likely be an escalation before we get to what Trump highlighted as a deadline somewhere between April 11th and April 18th. And there'll be a campaign of maximum pressure until, hopefully, a deal comes to the table. Now, what I think Iran believes and what the U.S. believes is that the longer we wait, the better deal that we're going to get. There's going to be a breaking point someplace. I don't think that's today, so I would fully expect there to be an amplification of some of the bombings and everything else that may go on. But the escalation is part of the negotiated endgame settlement process. So I think the markets are seeing this escalation, the exact same way that Jenny laid it out, is part of the endgame settlement process.
A lot to go with here. I want to start with what markets you think are pricing in right now, because if the president is correct in saying that at 8 p.m. tonight is the final deadline, and the U.S. could attack civilian infrastructure and essentially put Iran back to the Stone Age, as he's threatened in recent days, it doesn't seem like that the market is taking that threat seriously. Is that fair? So
the market pricing is, if you think of this as like a distribution, like a normal distribution, there's definitely a left tail where things can go really, really badly, and the markets may not be fully accounting for that. However, there's also a right tail where things could go a lot better and oil prices could come down, and then we can resume those initial conditions. What the market does is it finds the midpoint. So what we're really saying is that, yes, things could get materially worse, but there's also another tail out there where things could get a little bit better. So it's a good question that you're asking. Does the market fully anticipate this? On a probability distribution, on a weighted probability distribution, depending on how you think of these events and how much you weigh these events, yes, it is. It just means that the tails are pretty far. What that also tells me is that there could be a lot more volatility, because depending on which way it goes, it could be volatility to the downside, it could be volatility to the upside. So that's what the markets are effectively pricing in right now.
What's the longer term impact of all of this? And I guess I keep thinking about increased defense spending around the world. So then what isn't there money for? Or there's growing deficits, Jim. I also think about every nation seems to be thinking about their national security and whether that means water, energy, technology. And there's a cost of doing this on our home front.
Yeah.
What's the cost of that, and what's the impact of that?
So that's a great question. And this is exactly what our team is trying to think through, is the second and third order effects. The first order effect is oil prices are high and that hurts the consumer. Second, third, fourth order effects go much further down the line. So the cost ultimately it's not obviously just in the U.S., it's also in Europe as well. It's raw materials, it's agriculture, it's fertilizer, it's food, it's PVC pipes, it's all these shortages. I mean, I just saw today that used car prices are going back up again, and they've reached highest levels since 2023, like during the COVID pandemic, right? Because of chips and all of these various things. So when we're going
to have a conversation later about inflation, and they're saying it's more like 2022 versus some other inflation spikes.
Yeah, anyway. No, that's exactly right. So the way that we're thinking through this as an investment team, because that's what we're qualified to do, is we're starting to find out and trying to identify where those choke points might actually be that could have a positive impact on asset prices and also where there could be a negative impact on asset prices. What does it do to the consumer? The consumer gets hurt. So if you had an expectation for GDP to grow at, say, 2.5% this year, it's got to be a lower number than that. How much lower? How much damage have we incurred, and what's the cost of that repair, and can it be repaired and over what time frame? What the markets are saying is that it's going to be tough in 2026, but if you look at the forward earnings forecasts going into 2027, they're still high. Analysts are always high. They will come down.
Right.
But does it come down to the point where earnings growth rates go to the low single digits, or do we stay around low double digits like 8, 9, 10, 11, 12%?
We don't know yet, though, do we?
We don't fully know yet, but what the market's trying to discount is it probably stays somewhere around like 10, 11% on average. Could be wrong.
Yeah.
But so far, we're going to get first quarter data, for earnings coming up. It's not, the month of March was bad, but, January and February were good. Right. So it's going to be a mixed message right now.
Yeah, JP Morgan, 1 week from today, we'll hear from JP Morgan. And then the other banks as well. Hey, okay, so this in the context of politics, because everything you're saying right now about affordability and questions about American consumers, I think is front and center when it comes to midterms. How do you think about that in the context of markets?
So the affordability is obviously it's a major issue, right? Gasoline prices moving higher. The consumer's going to feel that every single day, every time they fill up their car with gas. Look, the midterms are going to be tough. I mean, I'm hearing a lot of different people, very upset about what's going on. Who wouldn't be, right? But I think ultimately we have to see how this all ends, because there's another contingent of people that are saying, well, is it better to have a nuclear armed Iran, or is this the right, we had a date with this destiny at some point. We didn't know when that date was. The date's now. And so do you want to take this on right now, or is it a can kicking exercise where you just kick the can down the road and deal with it later? So I think the American people, once they get past the shock of higher gas prices and the dust settles on this, so to speak, ultimately it's going to be, the choice was a nuclear powered Iran, or nuclear, armed Iran with nuclear missiles, or something else. Which one would you have picked, and how much damage or how much pain did you have to take in the meantime? So it's a complicated question. So we'll see how it shakes out in the midterms, though.
Yeah, it's interesting. We've had a lot of folks say, listen, this was a war long overdue. This has been, tension, stress, dislike between the U.S. and Iran for a long time, as we all know. Does the U.S. come out stronger on the other side as a result of this? It's an interesting time in our history. Here we are, a quarter of a century, quarter of a century, 250 years old. But I just wonder how you think the role of the U.S.
I think we're going to have to wait 5 or 6 years to answer that question with accuracy. Right now, it seems pretty chaotic. Right now, it seems like the rules-based order is we're not following the rules in the rules-based order. We can make the argument that rules-based order really wouldn't tell us to do nothing right now, and is that the right solution too? So I honestly don't know the answer to that, and I think it'll be debated for decades going forward. I don't know that we're going to have an answer anytime soon. I certainly don't.
So do you have an answer in 40 seconds of what an investor should do in this environment? I know you like the U.S. over Europe. Just quickly, we'd be remiss not to ask.
Listen, I think that there were some great value opportunities in the value sector. Dividends, quality and defensive sectors are pretty good. Healthcare has been one of our biggest sectors. We think that benefits the most from AI over the long run. Love the healthcare sector, particularly in the managed care areas. That's really good. Technology, AI, and defense related, that's another area that I think is going to see exceptional growth. That's how we're positioning portfolios.